This meeting is being recorded.
Okay, good morning, ladies and gentlemen. Thank you for joining our latest series of Fireside Chat webinars with Siegel of Siegel Asset Management Partners. My name is Paul Duran, and on behalf of the entire team of Elco Management, I would like to introduce Eve, our sub-advisor for the income infrastructure and energy transition portfolios. I would like to remind everyone that today's call is being recorded and a replay will be available. On the screen are some important disclosures I'd like to share. And with that, Eve, I'll leave this up for a minute, but I'll hand it over to you.
Oh, great. There'll be a test on these disclosures at the end of the call, by the way. But anyhow, thank you everyone for joining us. I am really pleased to have the team of Cheniere with us today, especially Anatol, who will be the guest speaker. In the room is also Randy, who does a fabulous job on investor relations, and Francis, who helps Anatol with the slides. Just a quick bio on Anatol. He's the Executive Vice President and Chief Commercial Officer of Cheniere, and he's had that role since 2016. Anatol's actually a friend. He was a competitor at the beginning of his career when he started as a natural gas and distribution analyst at JP Morgan. Then he decided to move on, and he went to Bank of America, where he was the head of the global commodity strategy. And then he went to work for Lowe's, where he did energy strategy and was a portfolio manager. And then he had the brilliant vision to join Cheniere in March of 2014, and has had a meteoric rise there. Cheniere, as many of you know, is the leading producer and exporter of LNG in the United States. Total producing capacity right now is 45 million tons, and they have another 10 million tons per annum of production that is under construction. Before I turn the call to Anatol for opening remarks, there's 2 points that I need to make. Number one, Cheniere will be reporting earnings next Thursday. They'll have their conference call at 10 a.m. So we will not discuss anything that has to do with earnings. And then finally, and this might be the most important thing that I have to say, is that the reason that I asked Anatol to do this fireside chat is I think the market is really underappreciating the role of traditional energy, especially natural gas. I think natural gas is going to be around for a long time. Unfortunately, the energy transition to decarbonization is taking a lot longer than I think folks anticipated. And I think everyone on this call should be aware that natural gas is not only a very vital fuel today, it's going to be a vital fuel for many years to come. With that, guys, thanks again for doing this. Anatol, do you have some opening remarks that you'd like to make?
Yeah, thanks, Steve. Thanks for having us, and always a pleasure to catch up with you, and look forward to this session and the Q&A. Appreciate the kind words and of course the multi-decade friendship. So thank you for that. We did think that maybe we'll spend 5 minutes, just run through some slides for those who are perhaps not as familiar with the LNG world, or not as familiar with Cheniere, and then spend the bulk of the remaining time on Q&A. So if you'd be kind enough to pull up our version of the safe harbor statements, we'll pause on those for a minute for everyone to review, and then move forward to the next slide. Thank you. So we think the world, the LNG world, which is about 400 million tons today, goes to about 700 in 2040. We call that a doubling. Obviously, 400 to 700 is not doubling, but what ends up happening, and you can see this at the bottom of the slide, is a number of the legacy projects run out of hydrocarbons, and there's about 100 million tons of decline. So the 400 today needs to add 400, 300 of new demand plus 100 of replacement for existing capacity. You can see on here, the team has been doing this for the last couple of years. Our best guess over the last couple of years, and you see that the endpoint in 2040 hasn't changed very much, but the shape of the curve of how we get there has quite a bit, and that of course has almost everything to do with the war in Ukraine, and I'm sure we'll talk about that. But continue to see a healthy market, and the one piece that also below those curves that has changed dramatically is the wedge that is Russia. That was expected to be on par with U.S. and Qatar in the 2030s and 40s. Obviously, that is a much slower piece of the pie to develop now, given the developments in Europe. Flip forward one. So the industry has been quite healthy. If you go back to kind of the previous, let's say, down cycle of the second half of last decade, there wasn't a tremendous amount of contracting activity, and what existed was largely away from the U.S. projects and from Henry Hub indexation, with the exception of 2018. As you can see, the vast majority of activity was done on an oil index basis until early 22 came along, and the well over 100 million tons of long-term commitments that have been entered into have been dominated by counterparties looking to secure Henry Hub index long-term product. And there are a number of reasons for that. One that I mentioned already of Russia being out of the equation. Two, Qataris who continue to expand and will continue to expand conduct business only on an oil index basis. So if a buyer wants oil indexation, that is the place to go today. If a buyer wants something other than oil indexation, that is not the place to go today. You could have 3 years ago gone to the Russian projects, Novatex, and even Gazprom's, but clearly today that is not a viable commercial option. And as a result, the U.S. has captured the vast majority of that contracting capacity. Flip forward one. So from a Cheniere specific perspective, we've had obviously a very good couple of years in terms of commercializing our expansion projects. This year, we have been working on what is beyond the Corpus expansion, which is the Sabine project of up to 20 million tons. You'll see on the next slide the overall portfolio of customers, which is captured. You were too quick. Go back for a second. Which is also captured here with the logos, but 22 column looks comparable to another column, but as you can see in the legend, that other column is the aggregate kind of everything that happened before that put our 9-train portfolio, between that and 2018, put our 9-train portfolio kind of into existence, and everything we've done from 21 on has been for the expansion projects, Corpus that's under construction today, and Sabine, which will follow. You see here the pristine credit metrics of the counterparties and the tenor of almost 20 years. Our initial contracts at Sabine Pass started 2016, so those are quite a bit vintage, obviously, and that's what brings the average overall to 17 years, which is a little bit shorter than the tenor of the contract that we are entering into today. In the last batch of activity, the contract one of the contracts we entered into with PetroChina last year goes into the second half of this century. It runs through 2050, so quite a bit of tenor out there for us to be had. And you also see the composition here. What put our projects on the map initially were relatively standardized FOB contracts. At that time, they were all 20 years, and that's the first 7 trains, especially, have exclusively those contracts. Then, as we continued to evolve the commercial strategy, we started doing contracts on a delivered basis, both into Europe and Asia. And in 2019, we created this structure that we work on with North American producers that we call IPM, Integrated Product Marketing. And we've done that with 2 U.S. producers, Apache and EOG, and 2 Canadian, Arc and Tourmaline, where we take the product. It is structured technically as a gas supply agreement. They pay us a liquefaction fee. They pay us for our costs to achieve an international index, and we pay them the net back of that index. So that allows these North American producers to gain exposure to international gas prices, which obviously over the last couple of years have been much more robust than domestic commodity prices. And the last one, in summary, we have now just over 30 of these long-term customers. We are today operating the 2nd largest liquefaction portfolio, second only to the Qataris. Sabine Pass itself is the 2nd largest facility, again, second only to QE. We had the honor and privilege of being the LNG supplier, the #1 LNG supplier to Europe last year. Most of that is not courtesy of Cheniere itself. Most of that is courtesy of our customers that have destination flexibility, and hence we're able to take the product to the best paying market. And just from a scale standpoint, we are the single largest capacity holder of U.S. firm transportation, and we buy order of magnitude 7 to 8% of all of the gas that is produced. As a physical end user, we're by far the largest gas end user in the U.S. So that's the base story, and we look forward to your questions and insights.
Thanks, Anatol. I chuckle for wanting my insights. I appreciate that. Just going back to this slide, simply, what's driving demand for LNG? What is the natural gas being used for?
Yeah, it's a very broad range. One of the things that we kind of focus on and talk about is gas is a fairly substantial piece of primary energy, about a quarter, kind of on par with coal these days. LNG is only about 12% of total gas. So LNG overall is order of magnitude 3% of primary energy. It's a fairly bespoke solution. It's not like coal in China, obviously. And the answer to that is, to your question, is quite different. In India, for example, it is very much a fertilizer-driven industry today, with the next phases of growth being local distribution and power. In China, very much depends on the region and kind of the focus of the region. And in the Northeast, for example, it has been, and we think will continue to be, primarily a space heating equation with displacement of coal in central heating plants. In the south and southeastern provinces, it is to date largely dominated by industrial demand, and you have the overlay of gas generation that's only starting to play out in China, and that we think is going to be a big driver going forward. But it really depends on the specific market and what that market needs. One of our pillars of growth is Southeast Asia. There, while it's a good question of what is the end use, and that end use is largely a power driven equation, the fundamental driver isn't so much displacing coal or growth in generation infrastructure. It is a function of declining regional resource, both domestic and regional pipe gas resource. And as a result, LNG is plugged into that system via incremental import capacity and backfills the declining regional production. So the driver there, in a sense, is lack of local supply that's more economically met by imported LNG.
And can you just go back on your statement that demand grows from 400 to 700, but you have 100 of decline? What can you just describe what that decline is once again? Define it.
Yeah, I mean, really, before the U.S. came along on a world scale, you know, we always have this small challenge that the U.S. has had LNG exports, you know, for half a century with a small plant in Alaska and Kenai, but that was very small. So focusing on the modern era and the lower 48 export boom, which Cheniere kicked off from a construction standpoint in August of 12, and from a production standpoint only in February of 16. Before that, the LNG business was largely a integrated stranded resource business. The hydrocarbons were located somewhere where there wasn't a big market for gas, and was developed as LNG exports. And that is what you see overwhelmingly on this chart. Thanks for pulling it up. Back in 2000. So in 2000, the LNG market is a 100 million ton market. It doubled by roughly 2010. It had this period, unfortunately, post Fukushima that resulted in quite a bit of growth by the middle of that decade. But that 100 million ton market, and even the 200 million ton market of 2010, was largely driven by resource integrated with liquefaction. Yeah, and it's a resource is a depleting issue. So in many parts of the world, what fed those liquefaction facilities initially is now in irreversible decline. And so that's overwhelmingly that same Southeast Asian point that I was making earlier. And you see that wedge of whatever it is, green or aqua at the bottom, declining as we go through the coming decades.
Okay, so it's not necessarily that liquefaction facilities, you know, are basically aging out or retiring.
No, I mean, look, even again, even that small plant in Alaska, which was, you know, not a state-of-the-art facility by any means, ran for half a century. So there's no issue with keeping the plants going for you know 50 plus years. It's a question of hydrocarbons.
Do you want to touch on contract rollovers? Is that an opportunity for you?
Yeah, I mean, it certainly is in some markets, and you know, the industry 3-4 years ago, we probably would have spent a lot of time on this call on customer willingness to enter into long-term contracts. I think that's been resoundingly put to bed with the activity that has played out over the last couple of years. And then I'm sure you and people on this call have seen the tenor of the Qatari contracts, which tend to be between 25 and 30 years. So there's no issue with long-term commitments in this industry. We never thought that there would be. Our view was always that as the industry grows, there just will be more of everything. There'll be more long-term, there'll be more midterm, and there'll be more optimization opportunities. And you know, that's certainly what we've seen for our portfolio. And if you just create the formula for what this graph looks like from a contractual standpoint, the 20-year deals that were entered into in 2000 obviously have now expired and have been restructured, extended, you know, modified, et cetera. And that wedge of rollover continues to get larger as you move through time, because obviously 20 years ago, the market was larger. And as we look back, you know, next year, it'll be larger still. So it is unquestionably an opportunity. And it's an opportunity, for example, in mature markets, until China surpassed Japan in 21. Japan, basically for the entire history of the LNG market, was the largest LNG market. we have a fairly constructive view on Japan's LNG demand, not because we think it's going to grow, but because we think it's going to decline slower than Japan Inc. thinks it will decline. And of course, as a large participant over the decades that are behind us, it has a very large amount of capacity that is coming off contract. It faces a lot of challenges and a lot of uncertainty, but we think that the overall LNG demand into Japan will be fairly steady on a secular decline, but a slow and managed secular decline. That wedge of contracted supply that Japan has literally falls off a cliff over the next 5-6 years. So in a market, stable, modestly declining market like Japan, the opportunity to compete for that increasing wedge of demand that is uncontracted is the opportunity, very different than the opportunity we see in China today or Southeast Asia, for example.
And can you talk about the just LNG contracting today from several vantage points? One is you said that you signed an unbelievable contract with China in terms of duration, but who are the customers that you're talking to? The duration of the contracts. Curious about the pricing between oil linked versus natural gas, and how does that play into Cheniere? If somebody came to you and said, we like U.S. natural gas, but we want it to be oil linked, does that happen? And then maybe within that context, talk about the competition, especially as it relates to Qatar and Australia, and I guess also domestically as well.
Okay, there's like 17 questions in there. I'll try to remember most of them, but remind me.
Maybe just the contracting and the tenor of that.
Yeah, I'm actually going to answer your last question first because that's on this slide, and then we'll flip forward 2 slides, and then I'll come back. So look at the Australia wedge. Australia just isn't competitive. It's when it was kind of the residual only game in town, it had an interesting opportunity, and you see that playing out, really last decade. Woodside is going to bring on its expansion train at Pluto 2. Other than that, it's going to have a tough time just remaining flat. And that is a resource issue, that is an economic issue, and that is a regulatory and political issue. So Australia is not the place to go, in our view, for our customers, unlike US and Qatar, which continue to increase. Flip forward 2 slides if you would be so kind, and we'll hit on the contract. One of the things that we are very focused on going forward, one more, thank you, is as we manage this very large business of 45 million tons today, 7.5 or so BCF a day, on the way to, we've talked about Corpus, between what's under construction today, plus what we call our mid-scale 8 and 9, and some debottlenecking. Corpus today, which is 15 million tons, going to 30 million tons with the under construction debottlenecking plus additional 2 trains. So at that point, 45 becomes 60, kind of that's the current line of sight, and then Sabine up to 20 million tons more. So now you're talking about an 80 million ton portfolio. That's order of magnitude 11 Bs a day of gas demand to these 2 facilities. The operationally, it has a lot of challenges. One of the things on the last slide that we highlighted is that last month we hit our cargo number 3,000. We're very proud of that, not only because we are by far the fastest to get to 3,000 cargoes, but more importantly, every one of these logos that you see here, all of our foundation customers, we have perfect performance. We've never missed a cargo to foundation customer, through all the fogs, all the freezes, all the disruptions. And one of the things that allows us to do that is the fact that we do, even though we're well over 90% contracted, we do have a little bit of residual volume that we use to balance the portfolio, and that's retained for our own account. But the other very important piece is how we create our portfolio of customers. FOB is very elegant and in many ways simple from the standpoint that we don't need shipping. The customer comes to us, but it's very restrictive in the sense that all our currently almost 700 cargoes a year, almost 2 cargoes a day, are scheduled, and the entire LNG world schedules these cargoes, right? So if you're a day late or 2 days late, that causes ripple effect disruptions throughout the system. If you have a contract that is delivered to Asia or even to Europe, you obviously have a lot of flexibility as the vessel is on the water for 30 days round trip to Europe or 60 days or so round trip to Asia. And with these producer deals, these IPM deals, we get a number of benefits. One of them is it is gas supply, right? It is firm, committed, at this point, very large and growing amount of gas that's being delivered to us on a contractual basis for 15 plus years. Number two, our job is to attain the economics that we've promised to our gas supply customer. How we attain those, again, is completely up to us. Where we go, how we get there, the timing, and we have a lot of flexibility embedded in that. So we're very careful today, more so than we were, I would say, in the early years for a whole host of reasons, about portfolio construction, always the credits that we take into portfolio, the type of customer, the concentration risk, and this mix of FOB, DES, and IPM. I don't want to say that kind of in 2018-19, as we started working on these alternative structures, I would say we had a little bit of an eye on that, but that has become much more of a focus of how much exposure and flexibility do we want in all of these different buckets. In terms of tenor, again, it's been a fairly stable. The Qataris would say, again, the Qataris offer a very reliable product. It is always oil linked and it is always delivered. If you want something that's not delivered or not oil linked, don't go to the Qataris. If you want oil indexation from us, it's very difficult. We don't take commodity price risk. We have no commodity to price to pass through. And so while not impossible, in order for us to offer something that is not a liquid market sourced commodity that we pass through, we would need somebody that is taking that risk on the supply side, right? So we would work with a producer. The producer would be exposed to that oil indexation. And once you start thinking through how that could possibly work, it becomes very challenging. And ultimately, honestly, just the buyer is much better off going to somebody that is a structural oil-linked supplier.
And so, thank you for that answer. But I guess the last part of that was, when you're competing against other domestic companies, what's your competitive advantage? And it may
Yeah.
Yeah. Go ahead. Sorry.
Very, very good question. Yeah. So we ultimately we deliver a commodity, and the frameworks are fairly set in how you compete in that. And one of the ways that you compete in that kind of a market is being a low-cost supplier. We do not claim that we are a low-cost supplier. We do claim that we are a very affordable and over your over the tenor of your commitment, we offer a superior value proposition, not because we have the lowest liquefaction fee, but because we have the best performance. I'll give you a metric that I really like, which is that on a 20-year deal, the economics of a prompt cargo in dollars are equivalent to the impact over a 20-year deal in cents. So if you miss a $5 cargo, right, today, as you know, margins are plus or minus $10 for next year. So if you miss one of those cargoes, that is a 10-cent impact over a 20-year period. So as you think about reliability and why that's important, you miss a couple of those and your 5, 10, 15 cents of a headline liquefaction fee number is irrelevant in the context of volumes that don't show up. So our reliability, our ability to offer a variety of products, and not only a variety of products sort of over the term of the deal, but for example, we've had long-term transactions that start with one type of structure and then turn into another type of structure. So delivered basis for some period of time and then FOB thereafter. We obviously have a portfolio and we can supply from that portfolio. That concept of bridging volumes or early volumes, however you want to call them, has been very important, and a very large percentage of the transactions that we've entered into have that component. How that component is handled from a long-term economic standpoint varies depending on the structure and the counterparty, but we, over the prompt early period, we charge the market rate for those volumes. They're just worked into the long-term commitment. So, but having those volumes and having that security of supply and reliability is critical to a lot of these transactions. So, if you're a portfolio player with a large portfolio, you don't care about reliability, and you're just looking for the lowest liquefaction cost, we're often not the best option. But if you're an end user that needs that reliability to keep the lights on, to keep industry going, and values that long-term relationship and commitment, and you can see in our portfolio that there is a mix of all of the above, again, depending on what the counterparty's priorities are. We don't compete for market share. We only work towards a superior risk-adjusted returns. And as my boss always says, we're not in the FID business. And if Jack and Zach and the rest of the team get us to a point where the commercial value, EPC costs, and returns meet our objectives, we move forward. Otherwise, we use our free cash flow to return that to our investors.
So I want to get back to this notion that natural gas is going to be here a while. So if you have 45 million tons per annum capacity, and you said that you could go to 80 million tons per annum. I'm not sure by when you could get there. But let's assume that the last facilities are constructed by 2030, or maybe a little bit beyond that, and the life is 25 years. That would get you beyond 2055. How do you feel comfortable with that, and how would you handicap actually going from 45 to 80?
Yeah, so talking our own book, but that's why we're on this call. The runway for gas, we think, is very long, and will be a very robust market well into the back half of this century. On top of that, we also think, and we've had this view, for a long time, long before the the Russia-Ukraine invasion and war, that LNG is going to take market share from piped gas. And you see that, again, obviously, given the disruption of Gazprom flows into Europe of over 10 BCF a day, but even more so, again, in regions where resources being exhausted, and places like Myanmar that was supplying neighboring countries. We also think that natural gas has phases, and to your previous question of what are the end uses, those end uses change depending on the economy, the evolution of the economy, and the focus. So there's an enormous opportunity, of course, that we witness and continue to witness here in North America of coal displacement. We do think that will play out in the rest of the world, and that is a very big driver and a very big opportunity for gas. Obviously, as the world used a record amount of coal last year of well over 8 billion tons, that opportunity is there and is enormous. And then second, and also very large, is the combination of gas with renewables and backstopping that intermittency. We, of course, see that here. You're starting to see that in places like China and India and other parts of the world as well, on a scale that to date dwarfs other options for backstopping that intermittency. And we fully expect that to continue. And then ultimately, it is a mechanism to deliver alternative fuels, to deliver hydrogen in a very efficient way that will ultimately can be extracted to facilitate new fuels and reduced emissions that way. So that said, I think a little bit in anticipation of another question you may have, we do think that decarbonizing the system is very important and it is a big focus. And we think that that's going to be a very big contributor. The reduction in life cycle emissions is going to be a very big contributor to the relative attractiveness of our product and the sustainability for those decades and decades to come. Right? If we continue to commit to a cleaner and cleaner molecule being developed and delivered, that is something that will extend the runway, and something that's even in places like Europe, which included gas in its green taxonomy before the war in late 21, is a big factor in Brussels' consideration of how the EU will continue to use natural gas.
So flipping to the other side of the equation, well, before I leave there, in terms of when you get to 80, how confident that you are you're not going to go. The answer is how do you spend money for an LNG facility that probably has a 25 or 30-year life, unless you think that or you believe that you will not have a stranded asset?
Yeah, so a number of components to that answer. One is, we have views. We have lots of views, and so we have views about, next week and next year and 10 years and 50 years from now. We use those views in how we at times position ourselves, but we don't use those views for decisions on how we commit capital. Our capital commitments are based on very strict rules. One of those rules is that we have return of capital on a contracted only basis inside of a decade. So the first thing we do to mitigate your highlighted risk is we don't spend money on a project. We don't FID a project unless we're going to get all of it back, not in 20 years or 25 years, but within 10 years. We when we started sort of coming out and disclosing these parameters, we were a smaller footprint. I think we're probably at that time sort of had line of sight on 35 million tons. And at that point, we talked about being at least 80% contracted and no more than 95% contracted. Over the years, we've increased that floor dramatically for a host of reasons, and now are well over 90% contracted, well into the 2030s. And as we get some of those early 2011, 2012 volumes that again started to be delivered in the 2016 through 18 timeframe, we will continue to lengthen that contracted tenor as those volumes come up for renewal in the mid-30s. So expect us to, and we will not commit capital unless we have that contractual coverage and return of capital, as well as return parameters, credit parameters, all the other metrics that we continuously highlight. We will continue to have the portfolio very well contracted on a long-term rolling basis as well, and we're well over 90, really 95% through the middle of next decade even. So we again expect the 50s, 60s, 70s to be a very good time for gas as well, but that is a view, and that is not how we will prosecute investments, right? We will prosecute investments based on contractual returns and credit-worthy guarantees.
Thank you for that. The amount of natural gas that if you're successful and some others in the industry are successful, it's going to be huge relative to how much gas is produced in the United States. So how do you think about procuring supply? What do you think the appetite eventually is? I think we're exporting about 13 BCF a day of natural gas now. We're only producing 104 BCF a day, plus we're exporting via pipeline. So it's really two questions. One is, number one, where is the natural gas going to come from? And do we have the pipeline infrastructure in place today to satisfy that need? And then number two, if natural gas supply and demand gets tight and we start seeing $10 gas in the United States again, what's the potential for the U.S. government to say enough is enough and we're not going to grant export licenses?
Yeah. So when you and I were friendly competitors, in the olden days, we talked about a 30 TCF market and whether U.S. could achieve this objective of a 30 TCF market. Some others on this call remember that period fondly. We've obviously blown through that, and we've blown through that, coincident with the birth of the world-scale LNG export market that Cheniere brought to the lower 48. Over that time, as we've grown from what was roughly tended to be about a 70 BCF a day market to your number of 103, 104 today, absolutely, the LNG industry was born, the exports to Mexico blossomed, and today, as you said, LNG exports run around 13, 14 Bs. So of that 50% increase from 70-ish to 104-ish, roughly half is going into LNG exports, and it has been, as we've seen over the last almost decade, ably met by production growth. That production growth, lots of moving pieces, but the single biggest wedge to date has been the Marcellus, is producing 33, 34 Bs a day. So in some sense, it is entirely responsible for the delta between the 70-ish and the 104-ish. We, as Cheniere, we as the LNG industry have been beneficiaries of that, as a number of pipelines that used to flow into the Midwest and Northeast have been reversed, and some additional infrastructure has been built. I'm very pessimistic on the opportunity for the Marcellus to continue to grow. I think it's going to be a long time before we see, a management team propose and a board accept another, MVP or ACP type of large diameter infrastructure. So unfortunately, that very attractive resource for the foreseeable future is unlikely to be a big contributor to the lower 48 supply growth. On the other hand, we're very, very optimistic about what we'll see in Texas over the coming decades, and still fairly constructive on Haynesville, especially inclusive of East Texas, as well as the opportunity to redevelop the Mid-Continent. And we think that the growth of the LNG market from the current 13, 14 Bs a day to what we see as roughly a doubling of that by the time all of these under construction and some of the proposed facilities move forward can be met. Your question on infrastructure is absolutely critical. We in creating Cheniere, our predecessors created a very different and robust business model that incorporates gas supply into our fundamental model. Until this latest group of projects came along, we were the only ones that were prosecuting this model, and we have, as a result, a tremendous head start and a tremendous portfolio of pipeline infrastructure capacity that really can't be replicated. I mean, we have capacity on Texas Gas, for example, that is in the low teens. Today, that capacity is worth $2 plus, and even at $2 plus, even if you think that those are your economics on paper, I struggle to think that another Texas Gas will be built from Ohio South anytime soon. So answering the infrastructure question is absolutely key. We understand that, I would propose, better than anybody else in the business. We have a decade of experience on that now and growing, and the footprint that is unparalleled. We will not move forward with a project like a Sabine expansion unless we have a very robust gas supply plan that includes the infrastructure to supply it from markets that we are very comfortable with being incremental gas suppliers for decades and decades to come. So not in a surprise to no one, that infrastructure basically reaches back into the Texas market to access what we expect will be decades of production growth out of Permian, Eagle Ford, and ultimately Mid-Continent as well. Critical question to answer. I think a number of projects perhaps don't take it as seriously as we do. This is the only thing we do, right? We every day wake up to feed and reliably run two of the largest infrastructure assets in the world, and reliably produce now 3,000 cargoes and counting with a perfect track record, and that's something we will not sacrifice for the sake of growth. Again, just like the returns, just like the return of capital, our ability to securely supply it for many decades is a requirement for us to move forward. But it's a very, very valid question, and not something that that is an easy button. 5 years ago, 10 years ago, there was a lot of underutilized infrastructure in the lower 48, especially along the Gulf Coast. That is no longer the case, and I think a lot of fireworks will play out in basis markets over the next years and decades.
How vocally is Cheniere in terms of Washington, D.C. and pushing for permitting reform?
Look, we have a very good relationship with regulators. We have some staggering stats on how many regulatory engagements we have on a daily and annual basis, and that's FERC, that's PHMSA, that's all the regulatory bodies. We've obviously prosecuted our projects, permitted, constructed, operated safely, reliably through many administrations now. The initial permits were under Vice President Biden's watch, and every period brings with it challenges. We're very vocal about the pipeline infrastructure issue that we just discussed, where we view it as a partnership between us, our upstream partners, and the regulators, and we make our views heard, and we engage with FERC and PHMSA on those fronts on a regular basis. The commissioners and staff are, and through these various administrations and periods, are supporters of what we do. We think that in part they are, because we do it as safely and reliably and environmentally soundly as anyone. And there's always room for improvement, but these are healthy discussions and healthy engagements, and we expect them to continue. The issue of infrastructure challenges is not a surprise to anyone, or is unique to the interstate pipeline system.
So I think we have 6 or 7 minutes left, because I want to be mindful of your time. So let me just give you the last several questions that hopefully we can fit in. One is, how has Russia changed the landscape in terms of LNG? The second is that in your description of Cheniere on your website, you say Cheniere is also pursuing liquefaction expansion opportunities and other projects along the LNG value chain. So the question is, what are those other projects along the LNG value chain? And does that include carbon capture, responsibly sourced natural gas, any potential that perhaps you could think about exporting ammonia or hydrogen? Are those things that you are considering? And then lastly, what did we miss in terms of what we should have discussed that we didn't discuss, and any parting comments after you go through those couple of questions?
And you left 6 minutes for that? Okay, so Russia has been a huge impact on the LNG market. Europe kept its lights on. Europe was a order magnitude 55 BCF a day market, and it lost order magnitude 20% of that in the first half of 22. So that was met through a number of levers, flexible LNG being the single largest one of those. And as we've already touched on, the wedge of supply that is Russia is very different today than we expected it to be 3 years ago. The contracting that is on the previous slide would not have happened to the same extent, and would not have been as focused on the U.S. Gulf of Mexico solutions had the Russian disruption not come along. We would have had a healthy period, but it would not have been this drinking from a fire hose of commitments, especially by these large portfolio players, IOCs that look to replace supply that they would have expected to receive from Arctic Russia primarily, and B, serve what they see as the demand, the structural demand that will exist for many decades to come. So Russia, especially Novatek, was our fiercest competitor. Those guys would do anything at any price for any tenor, the honey badger of the LNG industry. So the lack of that competitor has had a very large impact on consumer behavior, economics in the industry, et cetera. Your question about liquefaction growth, remind me.
Yeah.
Well,
I guess the easy one would be China, and then we'll finish up with the last one. And China, in terms of how comfortable are you doing business with China, and also the fact that Russia is cozying up to China and talking about more gas to China.
Yeah, look, it's you know this as well as anyone. The global energy pie is a big pie, and one of the lessons painfully learned by some of our European friends is diversification is absolutely critical. You can't have 50+% of your eggs in one basket. China has always been aware of this as a policy and is that much more aware of it today. Look for China to continue to grow its ties with Russia and with us. One of the things that has changed the other way from the LNG pie is, for whatever it's worth, we thought that Power of Siberia 2, or sometimes called Altai, that pipeline was a mid-30s event 3 years ago. Today, we think that there's a good chance that that starts to flow before the end of this decade. It doesn't matter. It doesn't compete with us. It supplies. Pipelines are good for some things. LNG is good for other things. Even in a place like China, where you can build things much easier than you can through West Virginia, it's very difficult to build through large population centers. So if you want a nice coastal city with a port and access to LNG infrastructure and power plants that are developed along the coast, LNG is just a much better, more economic solution than running a pipeline from Central Asia or from Russia. So there'll be more of everything, including more LNG. There's a staggering amount. Just one staggering statistic to me is China today has 121 gigawatts of gas-fired generation, and it has another 46 under construction.
Wow.
Each gigawatt run as mid-merit or more is 1 million tons of LNG. So I'm not saying that LNG captures all 46. What I am saying is there's already 46 under construction. There'll be more, and LNG will capture a large amount of that because that's being built along the wealthier coastal provinces. You asked about LNG value chain and what we're looking at. So you've seen us invest in pipelines. You've seen us co-invest in pipelines. So part of the Corpus solution is a new pipeline from Agua Dulce. We are an investor in that pipeline. So things of that nature. CCS is something that we're very seriously investigating. We have the blessing of having these very large, very concentrated assets. And one of the components of that system is an acid gas removal unit that creates a very concentrated stream of CO2 by virtue of taking, 2.25, 2.5 Bs a day to Corpus and 4.5 to 5 Bs a day to Sabine. We have a very large amount of volume that moves through that AGRU and hence creates that, in Sabine's case, almost 1 million tons of pure CO2 that can be sequestered, and we're certainly very interested in working on that.
What are you doing with that CO2 now?
Right now, the same thing that happens to the other 40 billion tons of CO2.
Okay, thank you. Move on. Sorry.
Yeah. The hot button for me that you raised is RSG. I hate that thing. It's an abomination and is actually, I think, terrible for the industry because it's nothing. Like it's some rubber stamp by some entities that decided to charge $10,000 to to rubber stamp some things. It has no parameters, no standards, no issuance. It's the opposite, in my opinion, of what the industry should be doing. And of course, we're doing what we think the industry should be doing, which is partnering with the industry to figure out what emissions are, to measure them, to have that validated and reported, figure out what equipment to use where, et cetera, and do that scientifically, systematically, and in a way that can be audited and is transparent. This RSG thing is terrible. It's taken on another life. We've tried this before. It failed. Industry is trying it again. I think it's actually terribly counterproductive. The concept of what you're asking, we're all in on, right? Every one of our cargoes started middle of last year has a cargo emission tag that reports what the emissions are associated with that product. We're going to continue to move the industry to a more transparent, more continuous monitoring system. Lots of our friends on the infrastructure side and upstream side are partners with us on that, whether that's EQT, whether that's Williams, whether that's Kinder, whether that's TC, whether that's Pioneer and others. RSG itself, we are not fans of, and we think that is as greenwashy as you can get. And then, sorry. And then next generation fuels were.
I keep interrupting you. I'm sorry.
Never mind. Go. You go.
Well, I was just going to ask about ammonia and hydrogen.
Yeah. So next generation fuels were in a very early stages. We don't see kind of a natural fit for us yet. We're talking to our partners to think about how we help them with those objectives, but it's not something that you should expect from us in any meaningful way anytime soon. So those are as we've discussed, kind of the third phase of natural gas beyond displacing dirtier fuels, beyond backstopping renewables, and that's a discussion for the coming decades. In our case, like lots of others will progress that, and we hope to help them with that. And I guess where I would leave this is on Cheniere, we are first and foremost an overwhelmingly contracted infrastructure story. We have line of sight and dare say certainty on $20 of cash flow just from the per share, just from the line of sight expansions. That is not inclusive. That is through 26. That of course is not inclusive of some of the additional growth that we discussed. You asked at some point of how confident we are of getting from 60 to 80. And as you can see on this chart, 22 and 23 for the industry and certainly for Cheniere have been very robust years. We are optimistic today that we'll continue to successfully commercialize the Sabine expansion, which all of this year's efforts have been on. It is something that the contracting window is open today. We have very healthy engagements with North American producers, with Asian end users, with portfolio players, with a lot of the same characters. And in fact, one interesting dynamic is that the majority of the contracts we've executed this year have been with repeat customers. And we think while the contracted volumes will grow meaningfully from what you see today, the number of logos on the page may not. We've gotten to this, broadly diversified 30+ customer.
The recording is being recorded.
Okay.
All right. Enough of that. So optimistic, but again, the commitment from us is there will not be a merchant decision made. It will only be prosecuted to the extent that all of our investment parameters are met. And in the interim, we'll continue to return that capital to our investors. Having deployed over $40 billion to date, we're now in the enviable position of generating tremendous distributable cash and have gotten the complex to investment grade, have pivoted over the last couple of quarters to return of capital to equity, and that's something that you will continue to see from us.
Fantastic, Anatol. Thank you so much. Fantastic job. Randy, Francis, thank you for being there for Anatol's moral support, and good luck. Good luck next week on the earnings call. And thanks again. Really appreciate it.
Thank you, guys.
All right.
Thanks,
So
Steve. Thanks, Elko. Take care. Bye.
Bye now.